In this model, you get to learn what is a candlestick, how to read and interpret candlesticks, how to use candlesticks formation as signal confirmation tools. Pay attention to every details on this particular model and don't miss out anything, because this is what I call the real trading. If you miss any information here, you may be getting everything wrong in your trading. So you have to pay real attention. So a candlestick depicts the battle between the buyers and the sellers over a given period of time. As we said earlier, Forex trading is about buying and selling, but technically it's like a battle. And for example, let's say we have 100,000 traders at a given time, and let's say 60% of that traders says they want to buy euro, and the remaining 40% says they want to sell their euro. The percentage of traders who says they want to buy are more than percentage of traders who wants to sell. So since the percentage of buyers are very high, price tends to buy, because majority of the markets are doing what? Are buying, and price will do what? Buy. So that is why I say it's a battle between the buyers and sellers. So this candlesticks interprets what happens at a given period of time. So it's also an interpretation of price actions. It originated from a Japanese rice trader. So that is why you hear people say the Japanese candlesticks, So, but I just prefer to call it the candlestick. It's simple that way. No need to complicate matters. I don't believe in making things too bulky. I want to keep it simple and straight to the point for you. So know that a candlestick interprets what traders are doing in the market, what traders are thinking, how traders are feeling about a particular currency pair. So you can use the information being printed on these candlesticks to trade. And we have different types of candlesticks. We have the bullish candle and we have the bearish candlesticks. And every candlesticks you see consists of an opening price, a closing price, an high price, a low price, the body, and the wick. Here in this diagram here, we can see from this other candle here, this is what we call the wick. This thing that looks like a broomstick here, that is what we call the wick. And the blue shaded area is the body. And on top here is the high price, where the candlestick, where the wick stop is the high, and where the wick stop at this bottom here is the low price. So every candlestick has the opening price, the close, the high, low, body, and wick. So to identify a bullish candle is very simple. All you need to observe is, you notice that the bullish candle opens below and closes above. So if you see any candle that opens below and closes above, that is a bullish candlestick. And also any candles that opens above and closes below, that is a bearish candlestick. So at first this may be hard for you to identify. If you really pay attention to the chart and see price movement, you observe and you will notice what I'm saying. So I use these colors to differentiate them. Blue to identify a buy candle, and also the red to identify a sell candle. So these are the types of candlesticks we have: the bullish candles and the bearish candles. So let's jump into the variations of the types of candlestick formations. You look at the chart and you see so many candlesticks. All these candlesticks have names, they have meanings, but on this lesson we are just going to be focused on the important ones, the ones I look out for when I'm trading. If I see them, it gives me a lead, it gives me confidence in whatever I'm doing. So let's look at the first one. The first one here is the bullish engulfing candle. It's a two candlestick formation, and it's also a bullish reversal candlestick. It shows that buyers are in control of the market. So when you see this formation like this, when you see this formation, it gives you a clue, it gives you a signal that you need to buy. It gives you a signal that you need to buy. But first of all, you don't just jump into buying. Let's say, for example, price was trending lower like this, and it approached a support zone. When they approach a support zone, then the next candlestick formation gets bigger than the sell candle. This is a signal for you to buy. So you buy at the close of that particular candle. You buy at the close of the buy candle, and you set your stop loss few pips away from the signal candle. So when you see this formation on your chart at a support zone, it is giving you a signal that you need to buy. So that is how you buy a trade. Then the next one is the bearish engulfing candle. This is similar to the bullish engulfing candle. It's also a two candlestick formation. It gives you signals to sell. It gives you a sell signals. So you look for them at the resistance zone. So this formation gives you signals in the market. Like for example, if you should see a bearish engulfing like we are discussing now, it's telling you to sell. When you see a red candle bigger than the blue candle, you sell at candle close and you place your stop loss away from the signal candle and your TP down below. I believe you know what stop loss is. We discussed about stop loss in the Forex foundation course. We said stop loss are price levels which you put on a trade to avoid deep losses. For example, if a trade should reach your stop loss level, you are out of the trade automatically, even if you are not on screen, you are not monitoring the trade. So that is why we use stop loss. And this is what we call the hammer. Is another candlestick formation, and it looks like an hammer. You should look at this image very well. This particular candle looks like an hammer. It has a handle, and it has a small wick to the top and a small body. So this is what we call the hammer. Look out for the hammer at support zones. So when you see the hammer at support zones, it's a signal for you to buy. So you buy at the close of that particular hammer candle, and your stop loss is away below like this from the signal candle. The signal candle is the hammer here. So you place your stop loss away from the signal candle. Don't place it so close to the signal candle in case price wants to retest that particular region and you don't get stopped out of the trade. The next one is the inverted hammer. The inverted hammer, it's the reverse of the real hammer. This is a bearish reversal candlestick pattern. It shows sellers are in control. So you look for these inverted hammers at resistance zones. Don't bother yourself looking for it at the middle of nowhere. You look for it at resistance zones. When you see them at your resistance zones, that is when you sell at candle close, and you place your stop loss away from the signal candle. Stop loss is being called or abbreviated as SL. Place your stop loss away from the signal candle. And there is what we call the railway track. It's another candlestick formation. It's a bit similar to the engulfing candlestick, but the here is the different. The same body and the same height too. So you look for the bullish railway at support zones. For example, market is trending lower and it approaches a support zone, and you see this candlestick formation like this. After the bearish candle, you see a bullish candle like this, and they are of equal size and height. It also shows that buyers are coming into the market. Is a good opportunity for you to buy at the candle close, and you place your stop loss away from the signal candle. not on the support zone or on top of the candle like this. You place it away. Like if this is the candlestick wicks, you place it like few pips away from the signal candle there. Then the bearish railway track. The bearish railway track is the opposite of the bullish railway track. You look for this candlestick formation at resistance zones. So when you see them at resistance zones, you sell them at the close of the candlestick and you place your stop loss away the signal candlestick there. It shows that sellers are in control in the market, so that is a good reason to sell when you see such candlestick formation at your resistance zones. Here is the pin bar, the bullish pin bar. It looks like the hammer, but if you notice something, the bullish pin bar don't have a wick to the upside like the hammer. It does not have a wick to the upside. It's like you know this thumb tag you use in tagging paper or a notice to a notice board. Yeah, so that's how it looks like. There is no wick to the upside, so you only see the wick to the downside. So you look for the bullish pin bar at support zones. So when you see this signal candle, it's a good time to buy, and you place your stop loss below the signal candle and you buy from the candle close. There is also the bearish pin bar. It's also a reversal candlestick. It shows sellers are in control, so you look for them at the resistance zones. It's the opposite of the bullish pin bar. So when you see a bearish pin bar like this, it's a good signal to sell. So this is when you sell. This is when you take a sell trade from a resistance zone. So when you take a sell trade from a resistance zone, when you see this signal, your stop loss should be away from the signal candle like that. The tweezer bottom, it's also a candlestick formation. You look for them at support zones. When you see this tweezer bottom at top support zone, is a good signal for you to buy a particular currency pair or commodity. The difference between the tweezer bottom and the hammer or pin bar is that if you notice the wicks of the two candlesticks, they stop at the same price and reverse. This shows that we don't have sellers again in the market. There are more buyers. Buyers are coming in to push the price higher to the upside. When you see this happening, like the 2 wicks are the same like this and a small hammer, this is a good signal to buy. So you buy at candle close and your stop loss away from the signal candle there. The opposite of the tweezer bottom is the tweezer top. It's also a reversal candle, is a bearish reversal candle. So you look out for them at resistance zones. So when price gets to a resistance zone and you see a tweezer top like this, it's a good opportunity and signal for you to sell that particular currency pair or commodity. So you sell from here and let price move down, then your stop loss will be away from the signal candle. And this is another candlestick formation called the morning star. This is a morning star, and a morning star, you look for a morning star at support zones. Is a 3 candlestick formation. You use 3 candlesticks to confirm this signal here. So you can see the bullish candle trends higher and closes higher than the bearish candle here. So when you see this kind of formation at a support zone, it's a good signal for you to buy. You buy a candle close and you place your stop loss away from the signal candlestick there. So this is how you buy and sell in Forex, by just looking at these candlesticks at key support and resistance zone. And here is the evening star. It's the opposite of the morning star, but the evening star, you look for them at the resistance zones. So when price approaches your resistance zone and you see this kind of formation like this, it's a 3 candlestick formation and it shows that sellers are in control. It's a good opportunity for you to sell at candle close, place your stop loss away from the signal candle and you let your trade run. So it's as simple as that. It's very simple. And we have the dojis. The dojis are indecision candlestick pattern. When I mean by indecision is that if you see a doji on your chart, if you are trading and you see a doji, it's giving you a signal that the buyers and sellers are equal. There is no winner between the battles of buyers and sellers. When you see a doji, it's for you to take a break and look at what the next candle will say and also further price actions. But if you should see a gravestone doji, this is what I call the gravestone doji. If you see a gravestone doji on a resistance zone, then this gives you a clue that price will sell, because this is a rejection here. The wick to the upper side is a rejection. So when you see a gravestone doji at resistance, you can sell. Then if you should see a dragonfly doji at support zone, you can buy, because the long wick to the downside shows price rejections. So you can buy from the support zone. And there are things you need to consider when reading a candlestick, when you are trying to interpret a candlestick. Now, first of all, you need to look at the size of the body of the candle, how big it is. Is it big? If you have a big body candle, that is an impulse move. Now it's showing you that buyers are in control. If it's a big body candle and it's bearish, it's red, it shows that sellers in control. So you need to consider size of the body, and you also look at the wicks, how the wicks are long. If the wick is long to the downside, it means that prices are rejecting the lower prices, and if it's to the upside, you know that prices are rejecting the higher prices. So the rejections too gives you a clue on what to do. Let's say, for example, price reaches a support zone and we have a big buy candle, a big bullish candle, and we have a longer wick into the support. That is a clear confirmation that buyers are in control and you need to buy from there. So you look at the size of the candle. Large body shows greater momentum and the small body candle shows lack of momentum. So you consider the wick and the size of the body when trading. And to fine-tune your entries and exits, when you are using candlesticks formation as signal, you have to wait for the candle to close. Not because you just see the candle is forming and you jump into the trade. No, you need to wait for that particular candle to close. When the candle is closed and you see the clear formation, the complete formation, that is when you can take a buy or sell. Now, so you enter at the opening at the next candle. So you don't just enter at the formation when it's just forming. You have to wait for it to close, then you enter at the opening of the next candlestick formation. So your stop loss should be at least 50 pips away from the candlestick wicks. So let's say you saw an evening star like this, and you don't have to place your stop loss right here. You have to place it away, like 50 pips away from the signal candle, and in case price should reverse and want to test that particular level again before continuing to sell, you don't get stopped out. So you place it away from the signal and candlestick formation there. So that is what we cover on this particular model, important candlesticks consideration. I have few quiz for you, and first of all, I want you to comment on this video or comments here what you have learned. And first of all, I want you to tell me what is a candlestick, then mention 2 types of candlestick that you can remember, then list the components of the candlestick. So comment on this video what it's a candlestick, types of candlesticks, and the components of the candlestick. This will help track your progress in learning. So I really encourage you to learn and to answer these questions. So that is all we can cover on this particular model. If you want to learn more about price action click the link below this video. You see a link on the description below this video, so click on that link and you get to know more about price action. Thank you for your time. Don't forget to subscribe to this channel, A+ Trading Hub, and follow us on our social media on Instagram, on Facebook, and on Twitter on A+ Trading Hub. And if you want to contact me directly, you can also WhatsApp me on 0703 933 5695. If you want to learn more about price action, don't forget to click on the link you see below this video.